Is it too late to rotate into consumer staple stocks like Pepsi, which over the last year are up 15%, while broader markets and more speculative investments have completely sold off? Is inflation going to chew into Pepsi's profits? Is it going to be a problem in the foreseeable future? What is Pepsi going to do to combat inflation? We'll go through the Q3 numbers, which were just released over at Pepsi line by line. We'll look at revenues, we'll look at profits, we'll look at cash flows, we'll look at the balance sheet, and then finally we'll look at Pepsi from a technical perspective. Is this stock starting to look like a topping pattern? Is this stock going to roll over? Are you going to get lower prices or higher prices ahead for Pepsi? We'll answer all of those questions and more on today's show. What is going on, investors? Hopefully you guys are doing well out there, and as you can imagine, I'm doing great because earnings season is here, and we're going to have a ton of videos covering all the action. We're going to kick things off today with PepsiCo, ticker symbol PEP. Over the last year, stocks up 15%. Year to date, down slightly, down about 0.5%. But certainly if you compare that to cryptocurrency or basically any NASDAQ stock, this stock, including a lot of consumer staples, have been holding up incredibly well over the last year. Now, this is on the heels of PepsiCo reporting their Q2 earnings. Those came in at $20 billion in the most recent quarter. Like I talked about, I'm going to go through line by line. We'll show you all the different things that you're going to need to know when it comes to Pepsi. But the growth on that revenue side, up 5.3% in the most recent quarter. They did beat expectations on that revenue side by about $720 million. The EPS came in at $1.86. That beat expectations by about 12 cents. They also gave us kind of a full year 2022 guidance for essentially the next two quarters. Since this was Q2, they give you kind of guidance for the upcoming Q2 quarters, and guidance for PepsiCo actually came in relatively strong, expecting a 10% kind of organic revenue growth, which is really kind of Pepsi and Coke's kind of a growth model or their growth metric they kind of measure themselves against. They use that kind of organic revenue growth, which strips out any acquisitions that the companies might have made over the last 12 months. The prior outlook was an 8% growth. This company is also returning a lot of capital to shareholders, $7.7 billion over the next two quarters, with dividends expected to be about $6.2 billion and another $1.5 billion in buybacks. This company is doing a lot of shareholder-friendly things. Now, what's also not being friendly to a lot of people is this whole inflation thing. And the PepsiCo CFO got on the call, and they said that, look, inflation could last potentially for years, but they are going to be protecting their margins with cost cuts. We'll talk about how they cut their costs over at PepsiCo here in a second, but also price hikes as well. And we'll see how those price hikes get passed on to the consumer. We'll see in subsequent quarters if they actually have to raise the price of your can of Coke, or in this case, your can of Pepsi and your bag of Frito-Lays. Will consumers eventually start to push back on that? We'll see. But one way that this company in particular really fights inflation is that they actually start putting less product in the packaging. Now, it's much, much more difficult to do when it comes to like a liquid product. Okay, a can of Coke and a bottle of Pepsi has kind of been the same for ages. But Pepsi in particular has an advantage when it comes to bags of chips, is they actually start putting less chips in the bag. And I think some people have done some calculations that there's 5 or 6 less chips in the bag now than there was just several months ago. That's the first step that this company does in order to kind of maintain their margins, in this case, protect their margins, and also kind of cut cost at the same time. Obviously, less bags in the chips, less cost going into the bag of chips. Now, in terms of valuation over at PepsiCo, so a lot of people have been kind of rotating into these consumer staple stocks over at Pepsi. And what we've seen is the valuation multiple kind of gets stretched on these companies, where a year or two ago, Pepsi was maybe viewed a little bit like a value stock. Well, now the stock's continuing to rise. We'll look here in a second. The earnings are starting to shrivel up, not necessarily due to PepsiCo's own doing, but we are seeing earnings kind of contract a little bit, some of it due to inflation, some of it due to outside things that Pepsi just simply cannot control. But we're seeing right now, Pepsi's trading. I've got a price to sales, kind of a 5-year chart of a price to sales over at PepsiCo. And we're seeing that we're trading at about 3 times sales over at Pepsi. And historically, over the last 5 years, when you've approached 3 times sales over at Pepsi, well, that is when the sellers have stepped in. We'll follow this up with some technical analysis here in a second and see if we see evidence of the sellers starting to materialize at that higher price, and see if we can get some lower lower prices in the future for Pepsi. Now, let's jump into these Q2 numbers because they actually are quite interesting. So what I like with Pepsi is they give you a breakdown of all their different divisions. So we've got the Frito-Lay, this is your chips, you've got your Quaker Foods, this is your oatmeal, and then you finally have your PepsiCo beverages. This is obviously your Pepsi and your Mountain Dew and those types of beverages. We see here with the PepsiCo beverages, this is the largest business segment that from a revenue perspective that PepsiCo operates under. $6.1 billion in the quarter. Last year on a quarterly basis, just marginally higher. We see for the last 6 months, similar story, although we have a little slight improvement over the last 6 months in terms of that revenue. But the thing to understand over at PepsiCo is the bread and butter of the operating profits of this company is actually in the chip division. So you see the chips went from $4.5 billion in revenue all the way up to $5.1. You love to see that because you know that those operating profits are very juicy in those potato chips. That's why we pay a lot of attention to the fact that PepsiCo can pull back the number of chips inside the bag and still charge the same amount. It's already kind of a wildly profitable business, and it looks like to me over the next 12 to 24 months probably will be even more profitable because I just don't think consumers are going to be pulling back on how many chips they're eating in an inflationary environment. So you see here the PepsiCo beverages, while they earn $6.1 billion worth of revenue, you come down here to operating profit and look at that, just $651 million. Last year you were at $809 million. So you're seeing a little bit of impact, I think, on inflation there. The fact that yes, you can raise the price on a bottle of Pepsi, but at some point consumers kind of push back on that. Whereas on the bag of chips, you can simply pull back on the number of chips inside the bag. You see profits actually went up considerably in that Frito-Lay division. I would expect a similar type of story to play forth over the next couple of quarters with PepsiCo, but there was some unique things going on with Pepsi. We see the total revenue went from $19 billion up to $20. We see operating profits, though, went from 3.1 down to 2.2, but there's actually some interesting reasons why. We come over here to the profit and loss statement, and we see our $20 billion worth of revenue, which is about $1 billion more than where we were on a 3-month basis a year ago. We see here on our gross profit side, still a fair amount of that is flowing down through gross profit. So while you have some increase in costs and some transportation of the potatoes and the sugar water that you're putting into these products, it's not substantial because you notice on your gross profit, you went from 10.3 up to 10.8. So you grew your revenues by about $1 billion, but your gross profits still went up a rather significant amount as well. Now we have selling general administrative expenses. Notice those barely budged from 7.2 to 7.3. This company is a very well-oiled machine from a delivery perspective, from stocking the shelves perspective. They do a fantastic job in that. Fact that we have not seen a lot of kind of labor inflation and pressures and even gasoline and energy expenses on this company. You see it holds true for the 6-month period as well, just barely budging on that selling general administrative expenses. I mean, this is up over $900 million, but you're growing your revenues by nearly $2 billion. In fact, a little more than $2 billion. Where the big impact on profits for Pepsi in the most recent quarter, and I talked about it, how we went from $3.1 billion in operating profit over at Pepsi in the most recent quarter down to $2 billion, is the fact that you had this impairment on intangible assets. And you see it's got a little footnote here of C, and you can come down here and you see we took a pre-tax impairment charge of about $1.4 billion in the most recent quarter based on the Russia and Ukraine conflict. So that really impacted profitability over at Pepsi because you take this $1.3 billion and you add it to $2 billion and you get a number much closer to $3.3 billion. And based on the revenue increases, based on the fact that our cost of sales didn't go up that much and our selling general administrative expenses didn't go up that much, you'd actually expect your operating profit to kind of increase about the same percentage, up another 10% or so to about $3.3 billion. Unfortunately, that didn't happen. They had to take this impairment. But when we get over to cash flows on this company, we will see that this is an impairment charge, not necessarily one that they have to take out of their pocket and give to somebody. So for the most part, investors are giving them a little bit of a pass on that shorter operating profits. Now, you flow down all the way to net income and you get down to about $1.03 diluted share in terms of its earnings. And you see that this company is very, very well positioned to pay their dividend. For the full year, they pay you $4.60. In the most most recent quarter, which again includes a $1.3 billion impairment charge, not necessarily a cash charge, that is going to impact your net income. You see for the 24 weeks, so for about a 6-month period, you're earning 409, very, very safe dividend coverage. We'll see that when we get over here to cash flows as well. So we pull down a 24-week net income number. Some of you might be wondering, where's that net income number coming? So you've got your 24 weeks here. You pull through all your costs. You come down here to net income. You get to $5.7 billion. You see last year on a 6-month basis, you were right at 4. So you pull down both of those numbers. Right-hand column is last year at 4 billion. Left-hand column is this year at 5.7 billion. Now guess what we get to add back? The Russia-Ukraine conflict charges of 1.4 billion. You get to add back in some depreciation, some other things. You come down here to cash flows of $1.8 billion. So still not that glorious of a picture over at Pepsi, because last year you're sitting on $2.3 billion worth of positive cash flows. Now you're sitting at 1.88. So we're seeing deterioration a little bit in those cash flows. And again, this does factor in that you get to add back in that intangible loss that they had to take over in Russia and Ukraine. Now, capital spending still maintaining. And I like this. Look, in this type of environment, companies like this should be playing offense, not necessarily defense. They're still upping their capital expenditures year over year. I have absolutely no problem with that. This company obviously does a lot of acquisitions, but they also sell products that they just simply don't think fit in their portfolio. And they gained a whopping $3.5 billion off a juice transaction that really juiced up the balance sheet, especially when it came to buybacks and dividends in the most recent quarter. Because you see here, $1.8 billion of cash provided by operating activities. Well, we blew through almost all of that on capital expenditures at 1.5. I told you this company paid a huge amount of cash dividends in the most recent quarter at $2.9 billion, nearly $3 billion. They also bought back nearly $700 million worth of stocks. Folks, that's over $3.6 billion worth of dividends in buybacks in the most recent quarter. So 3.6, probably closer to $3.7 billion worth of share buybacks and dividends on a company that had just $1.8 billion of positive cash flow. But again, most of that cash, or a lot of that extra cash, actually came from this acquisition. So you like what Pepsi is doing, okay? They divest from a business and they don't just plop that onto the balance sheet and really don't do anything with that cash. They actually took all of this cash and they were essentially cash neutral. After they paid down some debt, they did their capital expenditures, they paid your dividends, they did a buyback. They only burned through about $162 million worth of cash in the most recent quarter, which is quite frankly a rounding perspective when we're talking about billions and billions of dollars. When we flow down to the balance sheet, you'll see evidence of that. We've got a 6-month balance sheet from the end of last year to 6 months in this year. You see cash and cash equivalents basically the same. Accounts receivable up slightly. Maybe they're giving slightly better terms to some of their vendors. They'll collect that cash at a later date. They have a fair amount of inventory as well. We're seeing inventory stock up across retailers and those types of things. We're seeing that a little bit with Pepsi, although it's not necessarily a comparable period because you're comparing December to 6 months in, and it could be something with the seasons and how products flow. Certainly things like potatoes and those types of things could be that you stock up in your inventory now and you deplete it into the winter months. But all things being considered, our total assets almost identical, just up fractionally year over year. So they're doing a nice job over at Pepsi. While they had reduced amount of positive cash flow from operating the business, they had a large amount of money come in from a transaction that they divested from. They used almost all of that cash, in fact, just a little bit more, to pay dividends and have buybacks and do capital expenditures. So you're essentially neutral kind of from an asset side. From a liability side, we see that long-term debt ticked down from 36 billion down to 33, but it looks like most of that just kind of flowed back into kind of short-term obligations from 4.3 to 6 billion. They did a little bit of refinancing in the most recent quarter where they repaid about $1.6 billion on some long-term debt. They had some other $1.5 billion worth of debt, but they took on about another 1.9. Companies like this certainly can do that. All things being considered, from a cash flow perspective, from an operating profits, things are looking pretty good over at PepsiCo. Now, what's not looking that great is this stock from a technical perspective. Now, it's been locked kind of in this upper channel. And look, as PepsiCo tends to go on kind of, it gets in these channels and it just continues to trend up. Now, what's more interesting is the stock kind of really got in a very steeper upper channel as investors started rotating into of these stocks that they think would do well during an inflationary environment, which certainly is the case with Pepsi, and they rotated out of like, more speculative stuff that wasn't making money. Now, what I am seeing here is we've completely broken this trend. Okay, we broke this trend here, back tested and come back. So what I'm seeing now is we've kind of are starting maybe a new trend, and maybe it's going to be shallower. That is potentially possible, but we're absolutely seeing some sellers emerge when this stock gets up over $175 per share. And it would back up on the fact that when you look at a price to sales, you certainly could bring up price to earnings, pretty much any valuation metric that you look over at Pepsi. When it moves up another 4 or 5% in the stock price, well, sellers just tend to emerge. So in this scenario right now where we're at with Pepsi, let's say you own some shares of this one. Well, I think you could take profits up at this level at 171. Quite frankly, that is what I will likely do this week. If you don't want to do that, you don't want to churn your account, you don't want to absorb tax gains or those types of things, I totally understand. This wouldn't be an area where I would necessarily accumulate Pepsi, because look, as you can see, this stock is probably likely to come to the top of the channel up here at about $175. But if it acts like it has over the last 6 months, well, it's likely going to get rejected at that level and then pull back to a much lower level. In fact, Pepsi could retreat all the way down here south of $160 per share. That's if it does it in fast order. Remember that these trend lines continue basically into infinity until they are broken. So if it takes a while for Pepsi to kind of get rejected at that top of the valuation mark, well, it pulls back. Well, I think it could comfortably pull back right into this 160, maybe south of about 165. That would be the area if you want to still be in accumulation mode with Pepsi, and certainly with the dividends and buybacks that this company is executing, the valuation is still not wildly overvalued, certainly when you compare it to certainly unprofitable companies and ones that don't pay dividends and buybacks. Well, I have no problem with absorbing a stock like this as it makes these pullbacks. The real danger with Pepsi from a technical perspective is a break of about 155. So if you want to buy this stock as it pulls back, there's certainly areas where I would set stop loss underneath probably the 150 level. You get south of 150, you will have taken out all these lows that it have made, and then you're likely heading much, much lower, probably south of about 140 on this one. So in short, I don't like Pepsi at this price. It wouldn't be a stock that I'd be actively adding to, only because there's dozens of other stocks that are far more depressed that I would rotate into. But if you get a rejection that we're expecting up here at about 170 on Pepsi, and you pull back south of about 165, I think that would be the area where I'd be a little bit more interested in adding to a Pepsi position, or in some cases, maybe some of you are just starting one for the very first time. Hopefully you guys enjoyed today's video. That was Pepsi. We'll be back again soon with more this week. Good luck with your investments.